Udah online nih belum? Si Mas Erwanto monitor. Iya.
Masuk Mas, masuk.
Udah online nih belum? Pian, suara dengar ya? Oke, dengar ya. Oke. Ini udah join. Mas Erwanto, kedengaran nggak suara saya?
Ya, gimana Mas?
Suara saya bagus gak nih? Halo Mas Erwanto. Mas Erwanto. Halo. 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 Delay. Ini di sini dengar. Dengar di sini ada. Iya kan, dengar kan? Langsung. Yang sebelah delay itu. Ya kita ngecek buat jauhnya dengan ini aja gitu, ya kan? Tahu kan? Jadi orang lain nggak perlu dengar. Gimana? Dengar. Ada. Kecil ya? Nggak apa-apa, kecil dulu. Tadi agak masuk gitu loh. Agak delay tadi. Hah? Nggak dengar? Nggak ada suaranya? Oh. Ya, oke, siap.
Halo.
Tes. Yang di belakang boleh dong pada maju. Bapaknya mau naik ke atas nih. Ayo tolong. Silakan, silakan. Sebelum dimulai nih, yang paling belakang, silakan di depan dulu diisi, silakan. Terus pengumuman ditemukan sebuah dompet STNK mobil dan motor nih. Silakan. B26 74 UP UKI Oke. Atas nama PT Adi Sarana SNK, ada yang ketinggalan ini, ayo silakan. Sebelum digadai ini nanti nih.
Diinformasikan kembali telah ditemukan SNK satu buah SNK kendaraan Avanza B2674 Putra Kia EVO. Bagi yang merasa kehilangan silakan ke depan. Cek 1 2 3 tes 1.
Baik, untuk acaranya akan segera kita mulai. Untuk rekan-rekan mahasiswa, acaranya akan segera kita mulai. Assalamualaikum warahmatullahi wabarakatuh. Selamat sore dan salam sejahtera. And firstly, I would like to say thank you so much to MBA, UGM, and also Prof. Ted for accommodating our visit to UGM today. My name is Emi Amalia. I'm the country manager for the University of Melbourne in Indonesia. And this is also a long relationship with Universitas Gadjah Mada as well. In terms of the university relationship, we have MOU for between the University of Melbourne and Universitas Gadjah Mada. Yeah, can we continue? Yeah, and also within the faculty, we have some collaboration as well with Universitas Gadjah Mada. And part of the collaboration is for the MBA UGM program to our Master of Management program. So it is our pleasure today to be here in Jakarta, Prof. Ted, with our academic staff that the moderator will introduce later. And we are happy to meet all of you to deliver a topic of the modern world of finance from one of our academic experts. And also I would like to convey a warm welcome for students from Yogyakarta who join us online today. So thank you so much for giving your time to join this today lecture with Associate Professor Andrea Lu. So before we come to the session, I believe we should all have to wake up first and then sing the national anthem together. Right, Ibu Mia? Boleh berdiri dulu untuk menyanyikan lagu Indonesia Raya. Thank you. You may come back to the seat. UGM? Oh, nggak perlu. Baik. Selanjutnya saya ingin mengundang Profesor Eduardus Tandelilin untuk memberikan to pass the token of appreciation for Dr. Andrea Lu. Andrea, you may come to the stage.
Okay, good evening, everybody. Okay, I hope that everybody will enjoy this evening guest lectures from Professor Andre Lu, and my pleasures, right, Professor Andre, to come here to share the knowledge. And the topic is very interesting, right? So you can see the modern work of finance. So we have the traditional work of finance before, right? So now the modern work of finance. And thank you again. Also, I want to I would like to thank Courtmore, the recruitment managers, Faculty of Business and Economics, University of Melbourne, and James Michael, okay, country managers, officer for Indonesia, and also Amy Amelia. Thank you very much. Okay, to make this evening lectures, right, come true in our campus today, right? And thank you very much. And I have a small, token of appreciations for, okay, Professor Andre Lu. Okay, and we also have a gift for you all, right? Or our guests, right? And let me, give.
Oh ini Pak.
And Mbak Amy also.
Thank you so much, Professor Ted. And now I would like to invite Mr. Maxensius Trisambodo, PhD, to come to the stage as our moderator for tonight. And he will also introduce our speaker for tonight as well.
Okay, thank you very much. Good evening, everyone, student, and especially to Professor Eduardus Tandelilin, and also to all the delegation from University of Melbourne, especially to Professor Andre Lu. Welcome to University of Gadjah Mada. And today is very special for us because I think for me, it is my first time to see a lot of students in front of me. Usually I only see my screen, but now, thanks God, we have this kind of opportunity. And the second thing that's quite important today, that we will discuss very important topic that also part of the disruptive situation that we're having now. And we are lucky having Professor Lu, I would call Professor Lu, for giving us insights on the topic of modern world of finance. I think before we invite Professor Lu, I would like to introduce Professor Lu. Now is the Associate Professor in Finance and Senior Lecturer in Finance from the Faculty of Business and Economics, Department of Finance, University of Melbourne. And now she also Financial Research Network as also Vice President of Financial Research Network Women. And Professor Lu did his PhD in Northwestern University. I think this is one of the best universities in the world, in Kellogg School of Management, USA, and PhD in finance. Her research interests on empirical asset pricing, financial market friction, international asset pricing, and real options. That's all the topic that we learn from our course. So she published a lot of papers. She's kind of prolific scholars. One of the article that published in the Journal on Review of Asset Pricing Study on the title Market-Based Funding Liquidity Measures. Yeah, a lot of work has done and a lot of honors awards they have also got. So I have more than 4 pages of her work, and that's a lot. So we are proud of you, Professor. And of course, we will learn from her also a lot on the issue on financial market instrument, derivative security. That is one of the subjects that she did in the university. She also have a lot of students, yeah. So without further ado, I would like to invite you to come to stage, Professor Yu, please. Give applause to her, yeah. Thank you, Professor.
Thank you for the introduction. It's
Okay.
my
Yeah, you have about 40 minutes, Professor, to give your speech. Yeah, time is yours, Professor. Please.
Great, thank you. Is that okay if I stand up? I kind of don't know how to talk if I just sit down, so please pardon me. Thank you very much for inviting me to UGM today, and it's my absolute pleasure to be here to present. Thank you. And also, thank you very much for all of you. I can see that a lot of you came straight from work and spending the evening here to spend time with me to discuss about the topic of the modern world of finance. So thank you very much for your time and your presence here. As an introduction, my name is Andrea Liu, and I'm an associate professor at the Department of Finance from University of Melbourne. And I'm also the program director for the Master Management Finance program at the Melbourne Business School in University of Melbourne. It's good to know that UGM has a good partner relationship with the Master Management program. Hopefully that will be able to extend that partnership even further in the future. And also that I guess some of you here or your friends that's participate in that sort of partnership program with Master Management program. You'll probably see me in the classroom sometimes as well, because we actually offer our finance courses as part of the elective options for the Master Management program as well. So yes. So a bit about myself, like, my my academic background sort of can come from a combination of finance and economics. Most of my earlier training was in economics, and my later training was in finance. Okay, we know that economics is about decision making, right? It's about the allocation of
resources in general, whereas finance is focusing on a specialized area of, looking at how the financial resources are allocated. And I was one of the person that made the switch, but I understand that here in this room, most of the people are sort of coming from different major in the area of management. I heard that 20% of you are major in finance. Can you show me your hand if you're a major in finance? Hello, finance buddies. And how about the people who major in economics? Some of you, yeah, I can see hands, yep. And I heard that a lot of you are from strategic operations. Yes, yes, yes. So it's good to see that, there's all these different people with different background. I think that's particularly important because, you guys actually have their own day jobs and bringing those experiences in as well. So when I was thinking about, how do I talk about, what topic should I talk about to, obviously an audience or professional already with that experience, I'm going to be talking about something that's relevant and important. There are many things in finance that's happening right now. We know that, there's lots of new things that's happening every day. There's lots of fintech companies, there's Bitcoins, there's, all these platforms that's available like peer-to-peer lending, et cetera, et cetera. And then that's one of the things that fascinates me, right? Because finance is something that is constantly changing. Every day, every year, you will see a new thing that comes up. So today, when I was thinking about how to, what topic to present, I thought that I might actually bring you back to the most fundamental thing, which is that why we should be doing, why we should study finance, why we should learn about knowledge in finance, and why is finance important, okay? So hopefully, I'll convince you that finance is important by the end. So I want to start by a very simple example. Would you mind to move to the next slide? The clicker is not really working. Yep, it's working now. So suppose we're living in a simple world where we have two people, okay? We've got two agents here. One is called Mr. S and one is called Mr. B, okay? These are two individuals just like you and me in the room that, would get utility, get happiness by spending money, okay? But obviously how much they can spend depends on how much they earn and, how much they can actually use towards spending, right? So let's look at these two guys. One is Mr. S on the left-hand side. Let's suppose that he is an economics consultant that's working in the industry. He would make an income of $10 a month. And because he has a big family to raise, so he will have to spend $7 a month in order to pay for all the expenses, okay? So for him, because that he's made more income than expense, so therefore the expense that he can make in that month would be up to what he would like to spend, which is $7 because his income exceeds the expense. Whereas on the other hand, we've got Mr. B here, which could be an undergraduate student that's doing work, part-time work in the McDonald's, for example. So for him, his income is fairly low at $2. But he does have a lot of expenditure because not only pay for the cost of living, he also have to pay for an investment that goes towards funding his education. So the expense that he needs to make is $5. But because he lives in a world where income is less than expense, so in some way he's financial constrained. So if you leave these two people alone and just let them do whatever that they want to do, and not being able to cooperate with each other, what you will see is that I think my detail help to flip the slide. Would you, I'm sorry, go back a little bit? Go back one more. Yeah, it's fine. What you will see is that if we live in a world with no finance, you will see that Mr. S will be able to only make an expense of $7 because he's happy to do what he wants to do. But Mr. B will be very, very constrained, right? He would like to make an expense of $5, but in reality, he will only be able to make 2 because he only have the income of 2. But now that's when finance come into the world. If we have finance, maybe we can make arrangement, which is that Mr. S can give his excess of the $3 to Mr. B and help the Mr. B to increase expenditure from $2 to $5. Okay? But if we talk that to Mr. S is not going to be happy because why would I give away my $3, right? Even if I put that $3 under my mattress, that $3 will still be $3 tomorrow, and I can still use that $3 to buy something that I would like to do, right? So how do we make that happen? We could get a financial advisor in place and reach agreement between the two, which is that we could sell an asset, right? Which is that the Mr. B can say that I'm going to sell an asset to Mr. S, and then asset is really a piece of paper saying that you can use this piece of paper to exchange for future cash flow in the future. And in exchange today, Mr. S can pay for that buying that asset by giving Mr. S the $3. So the cash flow works like this. Today, the Mr. S will give the $3 to Mr. B, and then Mr. B will give the, in the future, give the $3 plus another additional amount back to Mr. S, which is to compensate Mr. S for giving away that expenditure today in order for, to give the money to Mr. B. I know it sounds trivial, right? But in this process, what you will see is that, don't go to the next slide. By having this trade on the asset, right, we are able to, get to one outcome that is better for everyone, right? Because for Mr. S, he can achieve what he wants to achieve in terms of making that expenditure of $7. But in addition, he can actually make a good investment of that $3 because the $3 is no longer sitting under the mattress and stay at the value of $3. But in the future, when he gets it back, he actually gets $3 plus interest. Whereas for Mr. B, what he's allowed to do now is that instead of having to reduce that expenditure down to $2 because being financially constrained, by trading that asset, he can now make his expenditure of $5. So both ended up being happier than before. I know this example looks ridiculously simple, but if you think about what they're doing here, that's really the essence of finance, which is that we are trying to allow the exchange of funds for the funds to flow from the side that has a surplus position where your income exceeds expenditure to the side that's having a deficit position and then have a flow back when the position reverse, okay? But why do we care about finance? Like, it could be just Mr. S, Mr. B. Why does everyone in this room, even if you're not majoring in finance, we need a bit of finance to make this world a little bit better? The reason for that is because if we think about who this Mr. S and Mr. B's are, it's really everyone in this world. Which is that if you divide the economy into those most important agents, like the households, the business and governments, you can always find yourself in either position of Mr. S or Mr. B, right? Because to us, the decision-making or the situation, the problem that we face is that we receive some levels of income. We need to make certain level expenditure. We're going to have certain imbalance from time to time. Sometimes we get more income than expenditure, so therefore we have surplus. Sometimes we have more expenditure than income, so we have a deficit position, right? For example, if in a household you receive income, your expense is the consumption or the investment into assets, right? If you're the business, right, income is basically revenue from sales and expense is the project, the money that you put into investment. For government, the income is a tax and the expense is the government expenditure, right? The reason why finance is so important and so relevant to everyone and why using the trading of financial instrument is going to benefit everyone in the society, at least at some point in time, is because that one is that every single person, including business, including government, basically every single entity in the government, in the society, we all have our own budget position. Sometimes it's surplus, sometimes it's deficit. The second thing is that our budget position is actually changing from time to time, right? It's not always guaranteed that we're always the one that's having a surplus position, or we are always the one that's having a deficit position. And the third thing is that even at a particular given point in time, we can have different budget position at the same time. For example, I could be saving in terms of, making daily, planning my daily financials, right? Having an income that exceeds my expense, my daily cost of living. But at the same time, I could be planning bigger investment in terms of mortgage payment, for example. Then in that position, in that horizon, you would be in a deficit position. So you could hold two different things at the same time. So because everyone can be Mr. S and can be Mr. B, and because everyone can be on either side, right, at different points in time. So what you will see is that there's a constant need for people to involve the trading of financial instrument to come in to play the game of improving everyone's budget position and their ability to enjoy living. Okay, so that's why that if you talk about the Eastern of finance, it's really about using the trading of financial instrument, for example, that simple asset that we talked about in the previous case, in order to get the financial resources to be allocated to the side that has a better use of it. In the previous case, that Mr. B obviously has better use of the money, because if you leave that $3 with the Mr. S, he will be putting that $3 under the mattress and it will be sitting there until the next day. Whereas when that $3 can get to Mr. B and fund his, university education, then from the society's point of view, it's not only that Mr. B was able to use that money, but also is going to sort of contribute to the improvement of the society. And then that's what the finance is really trying to achieve, which is the efficient allocation of resources. The question that it seems like, if everyone fit into that simple example, which is that we are either Mr. B or Mr. S, and we need the trading of financial instrument to allow the fund to flow to the right side, then shouldn't a simple loan just solve the problem? Why do we need to study finance? Why do we need to introduce all these different kinds of financial instruments in the world? For example, loans, stocks, derivative securities, or investment products like hedge fund products, mutual fund products, or other things like, currency, including currency derivatives, all these complex products that we have in the finance world. Why do we need to have that? The reason for that is because even though we're talking about this allocation of financial resources by allowing funds to flow through from one side to another side, but there's two elements that make things really difficult, okay? One thing is about time, because we are really talking about the exchange of funds, the flows of funds that goes one way today, and then the second part actually doesn't come back until a later part, right? But for someone to give up their today's consumption in order to, in exchange for the money to come back later on, you gotta compensate them for the time value of money, because they have to give up their today's expenditure, today's consumption, in order to make their sacrifice and delay that consumption, right? So when we're thinking about designing the financial products, we gotta think about when do they expect the money to come back, okay? And what sort of compensation they need required for them to give up today's expenditure and wait, delay their consumption to later for the cash flow to come back to them later, okay? And then the other side that has to do with the fact that we're dealing with very dynamic individuals in the world, right? Everyone have very different level of risk preferences. There are people who are very risk averse, like me, for example. Actually, I find out that most of the finance professors are very risk averse. I don't know if you are. Professor. But there are also people who are very risk loving, right? So if you're thinking about in the position of Mr. S and Mr. B, for them to be able to reach an agreement and by trading a particular financial instrument, obviously it's important for them to be finding the right instrument and right counterparty to trade with so that they feel comfortable. Okay, but that level of comfortableness comes from the fact that they need to find that level of riskiness in the financial instrument that match with their risk preference. And if, for example, that allows, that what that involves is them taking on additional risk, but because of the human nature of not liking uncertainty, they will have to demand for a compensation. You can always pay people more, give them more compensation for them to take on higher risk, right? So that's why that in terms of thinking about finance, we need to come into the concept of higher return need to be given for someone that's bearing higher risk. Okay, so if we take those two dimensions of complexity together, that gives reason to why we need to have all these different instruments out there, not just a simple loan. Because we need to have, even though all of these instruments out there, it doesn't matter, which one that are listed here, or even outside this list, that even if it's the most complicated instrument, all it comes down to is just a set of cash flow that allows funds to transfer from one side to another to achieve what we wanted to achieve on the previous page, right? But for people to reach an agreement, obviously, it's very important to have that instrument to match the need of that Mr. B and Mr. S in that particular context, so that a fund can actually flow from one side to another and reverse back later, okay? And then that's why we need to have different type of financial instrument, and we need those financial instruments to be traded to allow the fund to be flowed. And then that's why we need to have a good, efficient financial market to support the trading of those financial instruments. So now we know that we need to trade those instruments and allow the funds to flow. Let's think about how do we get that to actually take place, right? We know that we've got the Mr. S and we got the Mr. B, yeah? One way we can do that is that we can get them just to meet with each other and trade directly with each other. In other words, that one side is buying the asset, the other side is selling the asset, so they're the natural buyer and seller of the instrument, okay? That also seems like we don't need much in the financial market, right? Because all we need to do in that case is just create some instrument and leave the market to find its own natural buyer and seller. But the problem is that how easy is it to find a counterparty in this big wild world, right? And particularly when everyone have their own individual needs in terms of the time, what time they want the cash flow, and also what level of risk they're able to tolerate for the cash flow, right? So how do we find them? How do we let them meet with each other? That's when we need help in the financial market to achieve that, right? One example of this is that if I would like to invest, I've got the spare, if I'm the Mr. S and I've got that spare $3, right? And I'm looking for investment opportunity, rather than me going out and looking for my Mr. B, the market can come up with financial services to help me to do that. I can talk to a financial advisor that could tell me what is the product that suits my need, and then therefore help me to find the Mr. B. If I already know that, what if I'm the Mr. B, which is that I've got certain investment that I know I need to invest in because it's very profitable, it's a very good project. And I need to go out and look for the Mr. S that give the money, for example, if I'm the corporation that's got a good project, right? Then I need to go out and raise capital. How do I do that? If I can't find it myself, I will go to the investment banks, and the investment banks are going to be the people that help me to design and create the instrument that's going to, and also help me to find the counterparty that can help me to finance it. If we both sides are fairly confident with, stock being the perfect instrument for us to trade, right? But then it's hard for me to find the right counterparty. Then what the financial market can do is to create a meeting place, right? This meeting place can be called stock exchange, which is getting the buyer and seller together to meet with each other on this platform and get the trade to be executed and let the fund to flow from one side to another. And if no need help to get to the platform, that's when the stockbrokers will be able to help, okay? So you can see that obviously in the finance industry, just because of the simple meeting, we need to have a whole bunch of financial services and platforms that can help this matching process. And the purpose of that is really to help one side to find the other so the fund can flow. But even if one side can find the other side, right? There's still a problem because these two are completely different entities with different needs, right? The difference can come from the fact that the size of the cash flows are different, the denominations are different. It could also be the case that the maturities are different, right? One side could be the one that got the $3, right? But they only want to save the money or invest the money for 1 month's time. Whereas the other side, the university student might want to actually, want to borrow the money for 4 years instead, right? To pay for the whole length of his study. But even if we've got the venue to put them together, there's still a problem because time-wise, it doesn't match. We can't just leave them there, right? Then the way to do that is the financial market should come up with middlemen, right? What the middlemen can do is try to build a bridge between the mismatch. For example, in the case of denomination, in the case of the maturity differences, like the time length differences, what the middleman can do is that he can find, a whole bunch of those people that want to save for a month, right? And have them line up and then use them one by one gradually to roll it over a period that match the horizon that the other side need, right? And another example of trying to bridge those matches together is that, for example, if I would like to invest in a stock of Warren Buffett's Berkshire Hathaway, right? It will cost me a lot of money, even just to buy that one unit of stock, right? The financial market should not be there just make me realize that if I only have $100, stop me from doing that investment because I generally want to have this $100 to be put into a better place. For example, Warren Buffett's investment, company, right? The financial market should create a good venue for me to do that. How do we do that? We introduce the middlemen. Yeah, same idea here. Instead of having each one of us to find Warren Buffett and invest in his company, the middleman can basically collect a whole bunch of those small amount of money and put it into a big pool. And then that becomes big enough to invest into Warren Buffett's company's share, right? And what's another name for this? Mutual funds, hedge funds, investment funds, okay? And another example of this is that when you're doing this whole process, you're also dealing with the other dimension, which is not just this, denomination and maturity differences, but also you're helping to diversify the risk as well. With a small amount of money, you might not be able to diversify your risk and you ended up getting a whole bunch of idiosyncratic risk. But when you can pull them together, you achieve diversification. And there's also a whole bunch of other benefits like economies of scale, lower transaction costs. And if you think about what the finance market is doing, I hope you realize that by the time I've gone through the direct financing and the indirect financing, there's different ways that we can match the Mr. S and Mr. B together. We have really covered a lot of job in the financial industry, isn't it? Even though it sounds like a silly example of just helping out two people. But that's essentially what finance does, which is that playing those simple rules, but addressing the facts that people are so different. There's complexity in different dimensions. So therefore, we need to have the financial service in them and the intermediaries that's sitting in the middle to help the match to happen so that the fund can flow from one side to another. Now, given that we need to have them match, what else does the finance need to do? For the fund to flow from one side to another, in order to achieve the good outcome, which is that everyone ended up being better, right? Then there's a very crucial assumption here, which is that people need to make good decisions. How do people make good decisions? They first need information, right? They need information so that they can make a good decision. What sort of information do they need to know about? They need to know information about themselves, right? So if I'm either Mr. Is or Mr. B, first I need to know about what income I have, what expense I have. Obviously, in reality, it's a lot more complex than that, right? But before you make any good decision, you first need to know what situation I am in and what need do I have, right? Let's match it to what happened in the real finance world, right? That's when you need to have things like the financial planning, right? That help you to understand where you are, where you want to be. You need to have corporate finance departments, right? That help the company to know that what are the investment opportunities and what sort of financing is the best for them to get for them to get to where they need to get to. And also then you need to have a lot of information about the financial products as well, right? Because they're using the trading of the financial product to allow the fund to flow from one side to another. And then that's why that, you know, to understand the financial products, you need to have this whole industry of a financial analyst, the credit analyst, the underwriter to help them to do that. Part of the credit analysis is also about understanding the counterparty too, because if I'm trading a financial security with Mr. B, suppose that I'm Mr. S, and if I trade with Mr. B, for me to agree to enter into the contract, obviously I need to know if he's going to pay me back. This is a simple way of putting it because we're talking in the context of loan, but that's also true when you're investing in any asset, right? You got to worry about the certainty or in other words, the uncertainty associated with the cash flow, because any of the assets is basically just represents a bunch of cash flows, and that allows the funds to flow, right? And also that financial market need to perform a very important role, which is to allow the risk management to happen, right? Because if I start with a certain risk level and I want to get to the next risk level, if the financial market doesn't help me to get to my happy level of riskiness, then I will become reluctant to trade. If I become reluctant to trade, then the other party is also not going to benefit, and then the whole relationship just collapse down, right? And how do we do that? That's when we have those new instruments come in, right? The derivative securities. And to facilitate the trade of those derivative securities, that's when we have the traders and also have things like insurance brokers, foreign exchange traders, that's all helping to, you know, contribute to the risk management. And in terms of to facilitate the flow of funds, obviously, if we do it right in the financial market, we need to do it efficiently, right? But the efficiency really comes in three dimensions. One thing is that we need to make the right decision and allow the fund to flow to the right side, right? To the side that's going to bring the greatest benefit. So that's basically what we talk about in terms of the allocated efficiency. So for a financial market to be a nice and healthy one, obviously it needs to be designed in a way so that fund will be flowing towards the side that's going to help to increase the size of the pie of the society. So for a healthy financial market to be there, we need to think about what's good for us, not just today, but also in the future, in terms of having a sustainable society, in terms of having a sustainable finance, right? And also, even if we're living in today's like the right moment, we got to think about what are the market design that we need to have in place so that we can allow the flow of funds to happen in a very operationally efficient way. Which is that if we can achieve it with the low cost as possible to maximize the benefit, then we should do that. And then that's when you have a side of the finance industry that's really looking at the design of the market, thinking about all those tiny things that people wouldn't even pay attention to. For example, when you're setting up a stock exchange, how do you choose the smallest size of that price movement that would best allow the flow of fund? Right? In addition, the efficiency will have to be related to information, because one thing that is most fascinating in finance is also one of the reasons that I love finance so much, is because people would take their belief in their trading, right? And when they trade, that's going to change the demand supply of the asset and then leads to changes in asset prices. But thing about this movement in asset price is that from a market point of view, market can read information from those asset prices. And then that information that's delivered by the investor, delivered to the investors, they can help them to make better information. So we were thinking about how do we design a good and healthy financial market and financial system. It's obviously very, very important to make sure that we design in a way so that it incorporates information in a very healthy way and helping information to generate more information that's going to benefit other people's decision making. And the most important thing is that if I'm talking about finance can be, simplified down to that simple story between two individuals simply trading asset to allow the funds to flow from one side that doesn't need it to the side that needs it a lot more. For all of that to happen, we need to have trust, right? Because if one side doesn't trust the other, none of that will happen. What do we have to do to make them stay confident about each other, to maintain trust in there? We need to make sure that they're not scared. We need to make sure that they always feel comfortable and don't feel that they will be treated on an unfair way, right? If you look at the government policy making, right? That's closely related to that. If you think about government's response during the GFC, all these policy in place to try to stabilize the market, what that is all about is to maintain trust in the market so that people will continue to trading, right? And because if they don't trade, if they stay away from each other, then none of these good things that finance bring would actually happen. But this level of government intervention is not just during the bad times, right? At the good time, the government need to plan a set of policy that to make sure that the economy and the financial market and everyone here would survive not only through the good time, but also through the bad time as well. And also need to make sure that they've got the government regulation in place so that they believe there's a good level of fairness too. That's why we need to have lawyers, the regulators, the compliance team, so that they know if someone's doing the dodgy wrong thing, they're going to get caught, so that they will continue to participate in the market. And now let's get to the timing side of things, right? What I have really talked about is the fundamental of finance, okay? These are the things that you can trace back a long time ago, right? The currency that was introduced, a long time ago, like 3000 BC, was trying to, allow that, fund to transfer from one side to another. The issuance debt and share the creation of stock market, they're not new at all. They've been there for a long, long time, right? But if you look at the new side, right? Let's go to the next slide. These are probably some of the newer items in the market, right? For example, Bitcoins, for example, crowdfunding, like P2P platform for loan raising. And for example, new innovations in the stock market by introducing some of the new technology, like having the blockchain technology to be introduced for the distributed ledger in the stock exchange. These are very new. They're happening every day, right? New and more innovation are actually introduced on a daily basis, right? To point out here is that if you look at all of that, you can really draw a connection between what you see in the current newest, side of finance to that simple story that I've done, which is that you've got two agents. You've got with different budget position, and all you're doing here is just part of this facilitation of having funds to flow from one side to another. The only thing that is changing here is just that now you've got the modern technology to do it in a better way, such that we improve efficiency, we get allocated efficiency, we get informational efficiency, and we get operational efficiency too, okay? So that's why that I think when we're looking at the modern world of finance, particularly when we have tech, fintech, we've got all these new big words throwing at us. The way that we should approach them is not by thinking that that's a brand new thing. We need to take a new course and start from ground zero to understand them. That's not the way to do it. The way to do it is to still have the fundamental knowledge in finance and realize that they're really serving the old purpose that we have been dealing with for the past thousands of years. The only thing is that how do we combine the technology that we have now to do it better? And the only way that we can do so is by truly understand what finance is actually doing and then pick out those pain points where the new technology can actually help to improve on. So let me conclude by, putting in a little bit my own opinion onto, why finance is important. If you think about finance, right, actually, let me share a little bit. So I've studied finance for a long time. I'm an academic in finance. You have the finance in my undergrad, PhD, all the way. So I've spent almost 20 years doing finance. But whenever I run into someone, the first question that I will always get after people, I find out that I'm a finance academic is that, which stock should I invest in? How do I make a profitable investment? Okay. One thing that has always puzzled me for a long period of time was that if finance is all about this trading of stock and thinking about how to make money, but if you think about each one of the financial contract, right, it's always a zero-sum game, which is the fact that if I'm making the money, then there's someone else in the society that's always losing money, right? Or losing the amount of money that I made, right? So if you think about what finance actually have done to the society, if you focus just on the contract level, that zero-sum game, it seems like it has done nothing, right? And then that's probably the impression that people have about Wall Street, which is that there are people who love Wall Street so much, but there's equally same amount of people that hates Wall Street so much because every contract, there's a winner, there's a loser, yeah? But that's not what finance is all about. Finance is not simply about making money or not. Finance is about, by trading those contracts, actually directing the money, even if sometimes it means that you're losing money, but it's directing the money to the places that has better use of it, okay? So if you look at, come back to the simple example that I give at the very beginning, which is the fact that by trading the financial asset, everyone was able to put in, well, at least Mr. B was able to put that money into a really good use. That additional $3, instead of being sitting under the mattress, is really investing towards making the pie of society to become bigger and bigger. And how do we achieve that? We achieve that by trading financial contract, right? And it's the financial contract that really connects people together and allow the financial resources, which is a very valuable resources, to be put into the right place. So I want to conclude by taking a quote from Professor Robert Shiller from University Yale, who's a Nobel Prize winner. Where he said that not a single endeavor can be done alone as an individual, without an organization, and without resources. Every variable activity is interconnected, and finance is basically about creating the ripple of the human activity. So hopefully that, we'll all be able to contribute their tiny 2 cents into, helping finance to make the pie of society a little bit bigger. Thank you.
Well, excellent. Thank you very much, Professor Ru. I think you really raised very, very fundamental issue with respect to finance. What I learned from what you say is, although we already moved with the transition to the modern world, that the philosophy, the basic fundamental, still the same as the role of finance to the facilitation for creating better value for society. My friends say that actually, when we talk about green economy, for example, the challenge is not the money, but to find the good project that can get good money there. Okay, thank you, Professor, again, for very nice lectures. And we still have time for about 25 minutes. So I would like to invite student here, and also maybe later on student that maybe in the Zoom, and the online also to raise questions. So please raise your hands and then mention your names and your program, please. Okay, 1, 2, 1, and then 1, 2 or 3. Okay, let's start.
Thank you, as I Professor Wu for the presentation. I am also from strategic management. I am also from strategic management. In the presentation, we talked that funding is not simply about making money or not. That is trading the financial resources. Within the financial resources, right in the place to be the flow. But how about with the society? Doesn't work of the flow itself. The society needs to unify. Something like because person that like I do, I would years ago, I don't think about the failure. But I think about like the things, the money. I would things I would think about that because society the future of the I'm sure the people about that.
Right, I think that's a very good question, because I did sort of put my simple example in the way that I've got Mr. S and Mr. B, and this money looks like the money is going from Mr. S to Mr. B and exactly helping them, Mr. B, right? But in society, like in the finance world that we're living, we're not making the assumption that every single individual it's their responsibility to go out and judge which one is the project that gives the best to society, best contribution to the society. That's not what we're planning to do. What we're planning to do here is basically to create a whole bunch of assets so that you, with your investment view, for example, you just want a good return, right? A good return that suits your appetite of risk. And all you have to do is just go out into the market to buy that asset. Yeah. So for you, that's everything, right? For the financial market to work really well, the market should be designed in a way such that the trading of the asset and the involvement of the middleman, the signal that people's trading that sends in the market will eventually direct this money all the way to the people, to the group of people that has got the good investment that would actually increase the size of the pie. Right? So I think that's what the finance, and that's why the finance market is very, very complex, because we need this big complex market to find people together. But then also what we are doing there is we need to sort of create a very healthy environment, a healthy financial system, such that even though everyone is making their own individual personal finance decisions purely based on, what return do I get? But the market could be done in a way such that we give individual the right incentive to put down money at the right time, and that money can eventually be flowing to the side that needs it most. Does that make sense? Thank you.
Okay, thank you, Elsa. Is there anyone else going to ask questions? This fantastic, Professor. We have for about almost 300 participants
Yes.
online. So maybe from online participants, you also can raise questions. Feel free. Okay. Any questions? Or maybe, Professor, you say that we have a lot of instruments regarding the modern economy words such as Bitcoin, crowdfunding, and many others. Based on your prediction experience, which one that will be the dominance of finance in the futures from all the things, and then why it can be the dominance?
In terms of the financial instrument,
Yes.
I think it's very hard to say which one is the new one because the market is constantly changing, right? The market is not saying that we only have a finite set. We have to pick one from the finite set. But the fact that the financial market is actually constantly moving, you could just come up with a brand new one the next day, right? So I think it really depends on what sort of instrument can give the right incentive and fit the best need in the market so that allow the flow of fund to actually happen, right? Obviously, there's a different thing in terms of, what's popular in the market, right? And what attracts the most immediate attention. So that's why I also think it's important for the financial. I think one of the things that's quite important is about we need to make sure that there's informational efficiency in the sense that the financial market need to always provide transparent information to our investor so that they can decide out of this growing pool of instruments, which one is going to be better for them. And then therefore that's going to become the more popular one. But obviously, that's also the case that the list of instruments that trade do not just grow, right? That's also going to, some of the instruments are eventually going to fall out of the set because there's no demand, right? So I think what we should be expecting is that go with the flow and see that because the popularity of the growth of the instrument really depends on the demand at that time.
Thank you. Okay, I think there's a question come from the participant online, but I cannot see it. There's a question from the chat box. I can read that one. Okay, there's a question. Maybe I'll. Okay, come from how did cryptocurrency trading have a positive impact on society with the Mr. B and cryptocurrency market? Thank you. Okay, this is from Yasinta Dewi. Thank you, Yasinta. Please, Professor, can you comment on this?
That is a great question because cryptocurrency is one of the examples that we see that draws a lot of interest and a lot of popularity. There's a huge amount of demand for it, right? But then there's also different understanding about cryptocurrency. People at the beginning believe that this is a new currency that's going to replace the currency and even with benefit that could be better than the existing currency. For example, people believe that the traditional currency would be driven by the money supply, which is controlled by the central government, and then therefore the traditional currency would be prone to inflation risk, whereas the Bitcoin currency, the cryptocurrencies have a fixed supply side, so therefore it's not subject to the problem. Obviously, that's one side of opinion, right? But then if you look at the actual data, if you compare the movements of the cryptocurrency, obviously we know that we're living in a very high inflation world at the moment. But if you look at the performance of the cryptocurrency, it's not doing well at all, right? So the market in some way is trading in a way that's reflecting information, that's telling the market how they should interpret it, right? So exactly right. If you think about this, the market is not saying that the cryptocurrency should be there or should not be there, because the market is going to decide how beneficial it is, right? So in terms of, the old understanding about, cryptocurrency with this ability to inflation hedge, obviously that the current data is going to provide information to the market to do that correction. But also it's true that there are some other hidden cost to the society that is not trivial. That's not trivial to everyone, right? And then, for example, right, I think Cody, we at University of Melbourne, we've got a new subject that's offered to all undergraduate study that's called sustainable commerce. And then one of the things that they look at in terms of the finance dimension, which is related to this, is that if you look at the cost of cryptocurrency, it's not just that the computer is running, but all the electricity that's used towards generating to power the mining of the Bitcoin. So to the society point of view, this is not an efficient thing at all. But then at the end, it need to be the market. It need to leave to the market to realize that it is the case. And then that's why that, from the financial point of view, it's important to release that information into the market. So eventually people will have the complete information to make that decision, whether this is worthwhile or not.
Okay, thank you, Professor. Anyone going to have a question? Okay. We have time. Please. Yeah.
Thank you for becoming Professor Lu. A very interesting topic when you explaining about this. Hi, my name is Arya Paramana. I'm from strategic management class. I'm also a student from Amex. So thank you for tonight. So what I'm thinking is when you're explaining about especially is what in my mind is you were explaining about how is money works, right? So my question is after the currency itself.
Sorry, could you repeat that again?
So I say this, you explaining some practice what comes to my mind is you are explaining about how the money works, right? So when you give an example of the flow of money from the Mr. S or Mr. X or something like that, you do understand that actually money is kind of a medium for exchange. Money is just a medium to exchange, right? And the changes of the currency value is actually influenced by supply and payments. Yeah, so in this case, using your example of this Mr. X is little right, so I would like to make it if talking to X and Y is a country, something like that.
Yes.
As we understand that, let's say stable currency, meaning stable country, is more effective for investment. But how if one of the country, the currency US dollar, how let's say Indonesia, how we affect the investor coming to our country to let's say we get a kind of investment, so meaning money come to us, but our currency is not stable, just like the US, something like that.
Right. I think there's a separation. So in terms of finance, right, there's the money side versus the finance side. So what I was really talking about here is using the money as a means of exchange to allow to, for the funds to actually flow through, right? But the actions that finance is able to contribute, well, what finance can contribute to this whole process is to create an instrument for the money to flow, right? So I think there's a two separate issue here, which is that one is that you need to sort of make that assumption that you've got the currency, you've got in some way the stable currency so that it can be serving as the mean of exchange for the funds to flow. And then what the finance can add on is to create this asset to give reason for the money to flow around. But of course, I think that's something that's related to, something very important about, in how the finance works is that, of course, you need to have that stability, right? So in terms of, allowing by having the financial instrument, but introducing this financial instrument and expecting the financial instrument to do what it needs to do. This is what finance care about. We, of course, need to have the assumption of the mean of exchange being stable. having a stable currency. And then that largely have to do with the economic policy, monetary policy that's in place. So in some way that, the finance side, the trading of the instrument and financial market sort of sits on the assumption of using the currency as the payments unit of the payments, right? But for a healthy financial system to do well, obviously it's going to build on the need for a very stable currency to start with, because any uncertainty that's associated with the currency obviously is going to bring uncertainty to the trading of the asset, and then therefore uncertainty with what the finance can do. But then on the other hand, right, the financial market can do things that can help to hedge, to reduce that uncertainty. And that is when, trading of instruments like those foreign exchange rate products, like those derivative products that can do. But then, of course, that's not going to solve the fundamental problem, because that's only taken the market as given and you're hedging against it. But then the real solution, I think, would really come from the government policies. Thank you.
Okay, thank you. There's one more. Please. Yeah.
Hi, Professor. Thank you for the chance for asking the question. So, I saw that in the report, discuss. So one of the process, policy making, like regulations and our government. What I want to talk about is about the reason right now that I'm aware of that. So business during the 2008 financial crisis, and then I don't know 2007 financial crisis. What is your analysis on that one, Professor? I say that from this one, capitalism, I say that because of finance right now is lower than before, I say that sure, I think that's when that we are talking about the modern way of finance, which right now we talk about the cryptocurrency, the money flows to those cryptocurrency. We say that Bitcoin is now rising to the level that to the highest level. We say that the stock currency right now for the tech companies in the US, not only in the US but also in some countries in Asia also saw that the rest of the stock currency. So what is the point of view for these capitalism? Thank you.
Right. So I think if you take it from the media, right, typically people think that monetary policy is very much having a very inflationary effect, because the way people think about monetary policy, the quantitative easing is particularly thinking about as like printing money and then therefore injecting a lot of supply of money into the society, leading to the inflation to go up. But the important thing about quantitative easing is that it doesn't happen at normal time. It happens at a time when there's not much of liquidity going on in the market. But if there's not much of a liquidity, we still need to have funds to actually go around in the financial system to maintain that resilience. Let me give you a simple example, right? During the GFC, right? During the GFC, when all the prices were going down, but when the prices were going down, the liquidity was lacking in the market. If the government didn't step in to provide those quantitative easing, to provide those injections of funds, what's going to happen? The margin is going to, the margin call is going to get kicked in, and the price is going to go even further. And most importantly, people at that time, because of a lack of uncertainty, a lack of liquidity, that leads to a great increase in terms of uncertainty, and therefore more and more investors will choose to stay away, right? So that liquidity will really get into sort of that sort of liquidity trap, in the sense that it's only going to go worse and worse. So how do we go back to normal level? That's when it's necessary for the government to step in to provide that level of resilience. And that's actually very much related to what I was saying about the trust, right? Because when you get to that sort of a low liquidity level, it's very easy for individuals to lose trust about the market, and then they just don't participate. And if they don't participate, this whole thing is going to collapse, because everything builds on trust. And when you take the trust away, then it's not going to work. And that's the moment when the government really need to come in and put in quantitative easing, because what they are actually doing there is to provide resilience to get people out of here, right? So if you look at the impact of quantitative easing, right? If you look at the Greek GFC, the government also did a whole bunch of quantitative easing there. Did we see inflation? Not much. During the GFC, there was very low inflation, right? The reason for that is because the quantitative easing was actually exactly provided at the point such an economy is not doing as well at all, right? But if you look at now, you might be saying that, okay, the US have been doing a lot of quantitative easing now, but we're also seeing a lot of high inflation. So I think that's one thing very important to understand is that it's true, it happened around the same time, but the correlation might not be the reason for that. The reason for that is because if you think about what drives the inflation, the high inflation right now, it's not necessarily the fact that because we've injected so much of money. It's also because of the fact that there are some structural reasons for the high inflation. For example, the workforce is not back to normal, right? The pandemic has caused a lot of the companies to go out and look for alternative solution that is more robust and more resilient to the changes impacted by the lockdowns and impacted by changes in the supply chains. And also there's the effect of not just the quantitative missile of the quantitative easing, but more of the physical effects, right? The US government has paid out a lot of those physical payments to those, the employment benefit, right? And what we found out was that during the time when they paid out a lot of the benefit, couldn't actually, invest, didn't consume so much. So most of these money actually ended up going into savings account. And that savings accounts has translated into a lot of those irrational consumption. And then at the same time that those consumption are happening at a time when the cost is very high, right? So I think when you're looking at the impact of quantitative easing, it's important to think about what else is going on. I find it hard to simply just because these two things happen around the same time to put all the fault on the quantitative easing, right? The reason for that is because quantitative easing was a rescue strategy. It's like doing those, emergency treatment on a patient that's almost dying, right? But then later on, you could say that maybe you have done too much. But the problem is that if you haven't done it, then you wouldn't even survive to the day when you get to the next problem, okay? And then the other thing, that's what you told, I think the second part of the question was about Bitcoin, right? That's saying that what's the effect of quantitative easing on the trading, the price and increasing in price in Bitcoin. I think it's important to notice that the movements in the Bitcoin has been dramatically volatile. It's not just going up in one direction, but in fact, it's a very high volatility, okay? And also at the same time, it's true that when you have a lot of money that's circulating around in the economy, particularly with people with those spare money to spend, you can't guarantee that everyone is doing investment in a rational way. So if you look at the movements of Bitcoin, it's actually moves a lot with the sentiments in the market that's largely driven by retail investors. So I think when you look at, performance of these, additional assets, for example, you got to sort of think about all these different elements that's sort of happening at the same time, rather than just related to quantitative easing. Yeah.
Okay, thank you, Professor. I think there is a question in the chat box. Maybe one. Let's see in the chat box. Yes, there's a question. Oh, okay, not just. Okay, maybe we almost running out of time, Professor. I just want to have your kind of final comment, Professor. We are now living in the very vulnerable world with a lot of disasters, a lot of impact of climate change, and so on. It's bring a lot of risks, impact a lot of peoples, and so on. How do you see the modern finance can bring value in measuring this kind of situation that we're having now and in the future? How optimistic actually do you see that kind of the instruments, blockchain, crowdfunding, Bitcoins, can they help easing or bring value in the futures and when we are dealing with so many uncertainty and also the impact of climate change. This may be the comment. Can you give the comment?
Yes, I think certain aspect of finance is easy to provide information. For example, trading data, trading transaction, performance of assets, performance of hedge fund, mutual fund. It's relatively easy to get those data, right? So when we're making decisions about financial decisions, about where we invest, what's the impact of an investment, those monetary values is very easy to observe. But as what you're saying that, right, in reality, if we're really thinking in the right angle of thinking about what finance can do to the society, there's a lot of those intrinsic values that's not captured by financial data, right? For example, if we're measuring return, if we're looking simply 1 month ahead, we're going to miss out on a lot of important things that we care about, right? Positive news about research and development that may not kick into the stock price over the next months, but you might have to wait for 5 years horizon to think about the realization of that benefit. So I think it's very important for the financial market to, in some way, one is to encourage the information, particularly those intrinsic information, using technology to translate, to bring them into the market. A good moment in terms of, in the past, one of the reasons why we didn't care so much about climate and ESG is because we don't know how to quantify ESG, right? Even if a company or a fund has done the right thing, make the right decision, but you can't actually quantify what they have done. But a simple example of having the ESG rating of companies, of the funds, of portfolio of the assets, what's sort of the average rating of that is going to help the society to realize the value, and then therefore have them to face the right price signal and give the right incentive for them to actually make the right investment. And I think there's so much we can do in that room, or in that area. The reason for that is because technology can now capture a lot of things that we were not able to do. So in terms of the future movement, I really hope that the technology can help to bring in information, translate information, generate more information, and all of that information will combine with the efficient design of the financial market to really push the funds towards the size that's going to have a better use, not just in monetary sense of tomorrow, next month, or next year, but really directing to the greater benefit.
Wow, excellent. Thank you so much, Professor. I think we learned a lot from this is very important lecture that you will bring to us this evening. I think we give applause to Professor. Yeah. Again, once again, thank you so much, Professor, for your times, for sharing knowledge with us. And I believe what you give to us is really important in our way to develop knowledge in finance. Again, thank you so much, and enjoy your time in Indonesia. This is my first time in Jakarta. Thank you so much. Thank you.
Thanks. Yeah, and thank you everyone for your time tonight.
Thank you so much for the session, Andrea. And before we close the session, we would like to invite Frank Edwards, Pak Boyo, and come to take a group photo together.
Odi? Smile, Andrea.
Yeah, thank you so much, Andrea, for the session. And with this, we would like to finish the session. And also those who join us online.